Okay, with great pleasure, let me now introduce and welcome a very special guest, Anand Radhakrishnan, CIO of Franklin Equity, Templeton Investments. It's very difficult to get him on television studios these days. We've tried and tried and tried, and finally Anand has agreed for this interaction. So, happy Diwali. Thank you for joining us. And just for the benefit of those, the fund and the franchise which Anand
Happy
is
Diwali.
managing is one of the oldest mutual funds in India. It goes as back as 1993, right?
Yes, some of the funds we manage have been there for quite long number of years, 23 years, and have long track record. Yes.
You know, all of us, including me and Aisha and Tanveer, we have lots of questions for you, but I'm going to start with a very basic question. What is your view on the market? In the near term, it appears that the concerns which markets had about earnings recovery, they are getting addressed.
So, market is an aggregation of multiple sectors and stocks. As we see, there are some sectors and companies which are delivering reasonable growth, and there are some which are still struggling for growth. We can't say that like in the previous economic expansion cycles, in this cycle we have seen a synchronized growth of all sectors together. And that is not some kind of a trend which we have witnessed in this cycle. We have seen sectors or companies which are more exposed towards the consumption side of the economy have generally tended to deliver more predictable, less volatile growth. And even there we have seen differential growth rates between, let's say, staple versus discretionary spending, etc. On the investment side, we are yet to see a pickup in growth and therefore recovery in earnings. On top of it, we have financials where we have seen different trends, a set of financials which have generally bucked the trend and have grown and have delivered growth. And there are another set of financial stocks which have kind of struggled with growth, have had a legacy problem of non-performing assets, and therefore would not have delivered good earnings growth. So my guess is that this multi-paced recovery, a multi-paced growth is something which we have been living for the last 2, 3, 4 years. And hopefully, as more and more sectors the problem gets resolved, we would see more synchronized, much more broad-based kind of a growth as we look ahead over the next 2, 3 years.
Anand, hi, good morning and a very happy new year and happy Diwali from all of us here at ET Now. You know, I'm so tempted to ask you, if I look at all your funds, that's Blue Chip Fund, your High Growth Fund, or for that matter, your Build India Fund, your largest holdings are all skewed towards private banking names. I mean, yes, there is a larger portion allocated to SBI as well in the High Growth and the Build India Fund. But are you tempted to make any adjustments here? Maybe, reduce some of the private banking exposure and now increase the PSB exposure in light of this mega bank recapitalization plan which was announced by the Finance Minister?
It's a good question as well as a tricky question. There is a short-term view and there is a longer-term view. First, I'll probably explain the longer-term view. Over the longer period of time, we have traditionally been more positive on private banks versus state-owned banks for various reasons, because of autonomy of management, more retail-focused lending, much better credit control, ability to access capital, cost control, productivity, technology. For various such reasons, we have been structurally positive on that space, and it has generally proved to be a very fruitful kind of a decision to make over 5, 10, 15 years. Within that, of course, we have to be again stock specific, but we can safely say that as a segment, private sector banks have delivered long period value to most of our unit holders. And my own belief is that they will continue to do so as long as they compete well, as they keep their focus and they don't commit too big mistakes on the other. On the other hand, state-owned banks have been generally losing market share. They grow in spurts and then they go into some kind of a slow growth phase, and then they again come back. This is not the first time banks are getting recapitalized, and they do get periodically recapitalized, and that's been a bit of an issue for us, because we think that the real improvement or real reforms of these banks are yet to be made. While recapitalization and resolution of bad loan is a good short-term kicker for these banks, the real long-term kicker for these banks to be effectively competitive in the market and compete against private banks would be to reform them internally, and make them more autonomous and more result oriented, and probably get more talent, etc. So there are multiple angles to it. We would definitely get structurally bullish when we see more reforms. Any shorter term trend would probably make us tactically positive and wouldn't make us structurally positive.
Right. So if it makes you tactically positive, how would that influence your portfolio allocation to these banks in the short term? Because Anand, typically we've seen a lot of funds, not just India funds but global funds also, have had a portion of their portfolio allocated to these banks as a trading portfolio, which could generate the alpha for the overall fund. Because very seldom have people believed that PSU banks can move up in a structural manner. So they've always played for the trading rally, which has lasted for a couple of months. Is this time different, and would you think differently?
Again, it is a conditional upon the fact that how well this capital is used for resolution and growth. These are early stages. Typically, if the resolution happens along the expected lines in which we have kind of expected, for example, how much losses banks are willing to take in terms of haircuts in their loans towards stressed assets, would be a determinant of how much value they are able to capture, residual value they are able to capture from those NPAs. To some extent, therefore, some of this tactical bet is also a function of how efficiently and effectively this capital is used by these banks to achieve resolution of their non-performing loans. The more efficient they are in conserving this capital, and the better would be the reallocation of this capital towards funding future growth. You can use that capital for growing credit and in the direction or in business segments where the bank is feeling more comfortable. So, of course, markets won't wait for all these things. There will be some upfronting of in terms of these returns as we speak. So clearly, we need to take more. I would say, some of these calls need to be taken as things evolve. But as of now, I would probably say that our extreme negativism or is at the margin gets moderated towards more neutralish view. And any further addition to it would be contingent upon how well the banks utilize this capital for resolution and growth.
Anand, we always tend to quiz fund managers on what could change. What is the next big trend? Where do you think the puck is going to move? But I want to phrase my next question differently. What I want to understand from you is that what is unlikely to change, and where do you think earnings will sustain for next 2 or 3 years? Where do you see a double-digit, earnings growth with a little bit of P expansion, which could happen in next coming quarters?
So what we are seeing, stepping back from the shorter term trend, is a slightly longer term trend where there is a rising income, and that is leading to a shift towards higher discretionary consumption patterns. This discretionary consumption can happen in automobiles, in consumer durables, in travel, leisure, in branded goods, branded apparels, retailing, media, etc. I think India at the aggregate level is at the cusp of that transition from spending on staple goods to spending on discretionary items. And as the per capita income crosses this $2,000 per annum to closer to $2,500 per annum over the next 3, 4, 5 years, we would see this trend accelerate. And certain companies or businesses that are in the business of manufacturing or providing consumer goods in services on the discretionary space would continue to find very strong tailwinds in terms of their growth, and that is where we think a lot of structural opportunities would emerge for investors to kind of keep focused on consumption related, especially the discretionary consumption related items. Deepening credit on the retail side or the consumption side is another play. So most of these goods are not bought on cash, some of them are bought on credit, and therefore companies or financial services that are engaged on making sure that this demand or this need is fulfilled is going to again benefit from that. And there are multiple such themes which are revolving around the rising income and leading to higher consumption thing. That is one kind of a theme which I am extremely positive on. You can find plays across sectors to play under this particular thing. Some stocks might be expensive in the shorter term, so you need to pick your companies carefully. But I think once that is done, one can remain invested for 4-5 years and make a reasonable amount.
How come this theme which you mentioned is not getting captured in your portfolio? I have your top 10 holdings with me, and the only discretionary name which I can see in your portfolio, I have your last declared portfolio, I don't know if it's changed after that or not, is Mahindra and Mahindra. So there is no large consumer play here or a staple name here, or for that matter your you don't have any large exposure to a Maruti or a Hero Moto Corp. I'm just trying to understand that why your thought is not there in the portfolio.
No, we do have exposure to Hero Moto Corp and Bajaj Auto on the automobiles along with Mahindra and Mahindra. Maruti might have been excluded for more valuation reasons in the nearer term. We'll probably relook at it when the valuations become a little more appropriate. We also have exposure on other consumer durable like air conditioner manufacturers. Like it depends on which portfolio you're looking at. A pure large cap portfolio will have slightly more constraint in terms of number of choices which we can have on that. You will find some of these plays more available on the mid-sized companies. So those you probably can find more of them in Prima Plus or high growth companies kind of a fund. So we have exposure to names like an air conditioner manufacturer like Voltas or Bata or Titan, which is a play on some of the other discretionary spend perspective. So we look at it, and then there are some other retailing plays as well on the branded apparel like Aditya Birla Fashion or Arvind. So it's a theme which I see would gather momentum as we evolve into slightly higher per capita income. You can be early and then position a very large proportion of the portfolio, or you can take it as things evolve and as you find more opportunities where the prior value and growth equations become more attractive, then you can increase the exposure.
And you're one of the oldest shareholders in Infosys. Are you happy with the way things have settled down finally at the company? Now with the old boys gang back, and we hear that the CEO as well would be someone within the company itself, Mr. Nilikani, Mr. Murthy, all making peace. The Panaya acquisition seems a history now. It's been given a clean sheet, and yeah, while earnings continue to be a big question mark, and you could debate about what's really going on with IT as a cluster, and when earnings would finally come back into the sector. What is your understanding of the situation within IT and Infi in particular?
There is a sector view which has where the growth has clearly moderated over the period of time, and therefore versus the earlier expectations of growth, clearly the sector has trended towards much more moderate and sober growth, and Infi is no exception to that trend. So clearly valuations are also moderating in accordance to the growth. Having said that, I think the high single digit dollar growth seem to be probably a way forward for next few years before things change, and that is not per se bad compared to where the valuations stand. So had this single digit growth is on the back of 20 plus or 25 PE, then I would be very worried. If it is more in the early teens valuations, then it's not a big concern. So our growth and valuation disconnect is no longer that high in the sector, But having said that, growth is not very exciting per se. So that's a big picture. Within that, I think a company like Infosys has a little more leeway to improve, both in the way they use the capital, they distribute the capital, as well as some of the levers of growth. We do think that at the margin, some of these things may change for better. Management changes that can make this happen are definitely welcome. I think what happened in the past, we would put it behind. I mean, I think the company should put it behind and probably look towards the future and try to kind of create a more sustainable way forward for both themselves as well as the shareholders. We do see that with lots of cash generation and free cash flow, the company can generate more value than what the underlying business growth would justify in the nearer term.
Anand, what's the case for holding Bharti Airtel among the top 5 at a time when, the less said about telecom, the better, because there's been so much controversy with the space and challenges that the sector has been facing from every angle. And I don't see Reliance in at least these 3 portfolios among the top 5. So I'm taking that as an assumption that there's a preference or a higher allocation to Bharti versus Reliance. How do you look at the telecom battle and what it may mean for these 2 players in particular?
So we have traditionally been positive on Bharti because it's a large incumbent. They have a very established business model, as well as they have been pretty prudent in terms of their capital spending, etc. Having said that, definitely the sector went through intense price competition and consolidation. As we speak, the sector is yet to kind of consolidate fully. Our own understanding is that eventually the sector will consolidate around 3 or 4 players maximum, and with each of them having reasonable market share and profitability. The reason why we are positive is that as a sector it is not earning cost of capital, which means that the price of services is below what the economic pricing of the services should be, and that means there is at the margin there is going to be some upward drift on pricing, such that the players in the market have at least make economic return on their investments. Of course, it's not necessary that they have to make economic returns tomorrow or the next year or so, but theory says that if people don't make economic returns, they will look to exit that system, exit that sector, and that's what we are seeing. And recent consolidation move on included even Tata selling some of their businesses to Bharti. We might say more such views, and I think Bharti is in a very good position to consolidate, to play a good role on the consolidation of the market share, and post that probably it will be a reasonably strong player in the domestic market. Some of their overseas businesses are also doing relatively better today than what they were doing a couple of years back. So combination of all these factors have tended to keep us positive on the stock. And we are also reasonably constructive over the sector. Choosing Bharti over Reliance is a more conglomerated structure. It does many things, including telecom, which kind of makes us tough to analyze the profitability very clearly. It's also very early days in terms of businesses. But having said that, the stock has done well, and not owning that stock has relatively pulled us back in the nearer term.
Okay, so let me talk about another sector which is completely bombed out, pharma. Now, in your historical portfolio, you've had exposure to names like Sun Pharma, but now given that there is a pricing challenge, there is a US FDA challenge, would you like to avoid pharma? Because like you said in case of IT, that the disconnect between P multiple and growth is not there. But in pharma, do you think the disconnect is still very high and P multiples are still very elevated?
Optically, the PEs look high because the earnings have collapsed. But having said that, the earning capability of these companies have not collapsed. The reason earnings have collapsed is, the costs have run high ahead, and then the revenues have not happened for various reasons. Revenues have fallen short of expectations. partly because of intense price competition in the markets like US, and partly because the incremental approvals have not happened in that in these companies for various reasons related to FDA restrictions. We think the second reason, which is restrictions imposed because of FDA warnings, etc., will get gradually resolved. So companies will slowly get better approvals for their products, which will resolve part of the problem, which is the growth, which is being held back because of non-approval of new molecules. Whereas the price competition or pricing control, or I won't say control, I would say the intense pricing pressure because of consolidation of the distribution side within markets like US and Europe is something that is going to stay for is going to stay there for some more time. I do think that therefore at the margin every company has to make a choice on what category they would like to be present and exit the ones which are no longer remunerative for them to be. This process takes much longer time than we can imagine. So therefore, we are a little bit cautious on that trend, which is the pricing pressure trend, to alleviate in the nearer term. Then we have to look at what are the things that is there in the control of these companies. Clearly, cost is in the control of the companies, especially I would say R&D costs of frontline pharma companies are way higher than many of their peers, are not in commensurate with the revenue potential. So we do see some of them kind of scale back on their R&D expenses or look to innovative models to kind of partner with others on R&D efforts, such that you don't kind of double spend, triple spend on R&D. So there is a dire need for controlling costs. There is also need for rationalizing your product portfolios, etc. So we do think that subject to these things happening, you would see earnings recovery, but I would say that it's a bit hazy. The visibility is not that high. Companies have to yet to respond to this challenging circumstance with a clearer plan. We await that, and once we get that comfort, I would say that there may be time to be contrarian and probably buy some value there.
Anand, such a pleasure having you today on the show, and you should come more often on ET now.
Thank you. It's a pleasure talking to you. I will try my best.
Okay. On that note, we'll let you go. Thanks so much for joining in.